It doesn't start with some secret offshore account or a hidden bank on a tropical island. The loophole that quietly saves high-income earners tens of thousands every year is far less dramatic and far more accessible. It's built directly into the tax code, fully legal, widely used by those who understand it, and almost completely ignored by people who don't. And once you see how it works, you realize something uncomfortable. The system isn't just about how much you make, it's about how your income is structured. Because in taxation, not all dollars are treated equally. There's a fundamental difference between earned income and capital gains. Earned income, your salary, wages, bonuses, is typically taxed at higher rates. Capital gains, profits from investments held over time, are often taxed at significantly lower rates. That gap is where the opportunity lives. And for people who know how to navigate it, that gap can mean tens of thousands of dollars saved every single year. This is the foundation of what many consider one of the most powerful legal loopholes available, shifting income away from high-tax categories and into lower-tax ones. But the real strategy isn't just about investing. It's about timing, control, and deferral. One of the most common ways high earners reduce their tax burden is through long-term capital gains planning. When you hold an investment, stocks, real estate, or other assets, for more than a year, any profit you make when selling it is taxed at a lower rate than ordinary income. That alone can create a meaningful difference. But the real advantage comes when you combine that with strategic selling, because you don't have to realize gains every year. You can choose when to sell. And that control allows you to manage your taxable income in a way that salaried workers simply can't. For example, someone with a high salary might defer selling an asset until a year when their income is lower, perhaps after leaving a job, starting a business, or taking a break. In that lower income year, the tax rate applied to those gains may be significantly reduced. Multiply that across large portfolios, and the savings can quickly climb into the tens of thousands. But that's just one layer. Another major piece of the puzzle is tax loss harvesting. This strategy sounds complex, but the concept is simple. If some of your investments have gone down in value, you can sell them to realize a loss. That loss can then be used to offset gains from other investments, reducing your overall taxable profit. In other words, you're not just managing your wins, you're using your losses strategically. And because markets naturally fluctuate, there are almost always opportunities to apply this technique. High net worth individuals often do this systematically, reviewing their portfolios regularly and making adjustments to optimize their tax position. The result isn't just better returns, it's lower taxes on those returns. Then there's the concept of deferral, which might be the most powerful element of all. If you don't sell an asset, you don't pay taxes on its gains. That means investments can grow over time without being reduced by annual tax payments. This is often referred to as tax-deferred growth, and it creates a compounding effect. The longer the asset is held, the more it grows, and the more significant the eventual gain becomes. But here's where it gets even more interesting. In some cases, those gains are never taxed at all. This happens through a mechanism often called a step-up in basis. When an individual passes away, their heirs inherit assets at their current market value, not the original purchase price. That means any unrealized gains that accumulated over the person's lifetime effectively disappear for tax purposes. It's not a loophole in the sense of being hidden or obscure, it's a documented part of the tax code. But it creates a situation where long-term investors can build substantial wealth, defer taxes indefinitely, and potentially pass those assets on without ever triggering a large tax bill. And for families with significant assets, that can translate into enormous savings. Another strategy that contributes to this $50,000 per year effect is the use of retirement accounts and tax advantage structures. Contributions to certain accounts can reduce taxable income in the present, while allowing investments to grow either tax-deferred or tax-free, depending on the structure. High earners often maximize these contributions every year, effectively lowering their current tax burden while building future wealth. It's not flashy, but over time it adds up in a very real way. Then there's real estate. Real estate investors have access to a unique set of tax advantages that go beyond simple capital gains. One of the most significant is depreciation, a non-cash expense that allows property owners to reduce their taxable income even if the property is generating positive cash flow. In simple terms, the tax code allows you to treat a property as if it's losing value over time, even if it's actually appreciating in the market. That paper loss can offset rental income, reducing or even eliminating the taxes owed on that income. And when combined with other strategies like refinancing instead of selling or using structured exchanges, real estate can become one of the most tax-efficient ways to build wealth. But what ties all of these strategies together is a single principle. The wealthy don't just earn money, they engineer how it's taxed. They think in terms of categories, timing, and structure. They look at income not just as cash flow, but as something that can be shaped, delayed, offset, or redirected. And that mindset is what creates the gap between what they earn and what they keep. It's not about breaking rules. It's about understanding them deeply enough to use them effectively. And while some of these strategies require significant capital to fully leverage, many of the underlying principles are accessible at different levels. The idea of holding investments longer to qualify for lower tax rates, of offsetting gains with losses, of contributing to tax-advantaged accounts, these are not exclusive to millionaires. What differs is the scale and consistency. High earners apply these strategies systematically. They don't wait until tax season to think about taxes. They plan throughout the year. They make decisions with tax implications in mind. And often, they work with professionals who specialize in optimizing these outcomes. That's another key difference: guidance. Because while the strategies themselves are legal and documented, applying them effectively requires understanding nuance. Rules change, thresholds shift. What works in one situation may not work in another, and mistakes can be costly. So the loophole isn't a single trick, it's a framework, a way of thinking about income, investments, and taxes as interconnected pieces of a larger system. And once you start to see that system, you realize that the biggest advantage isn't access to a secret, it's awareness. Awareness of how the rules work, awareness of how decisions affect outcomes, and awareness that in many cases, the difference between paying more tax and less tax comes down to how and when you choose. And once you begin to look at taxation through that lens, as a system that can be navigated rather than simply endured, you start to notice another powerful pattern. The wealthy are not just minimizing taxes on what they earn, they are actively avoiding triggering taxes in the first place. That distinction is subtle, but it changes everything. Because most people think in terms of how much tax will I pay this year. High-level earners think in terms of how do I structure my life so that taxable events happen as rarely and as efficiently as possible. One of the clearest examples of this is how assets are used as collateral instead of being sold. Instead of liquidating investments and paying capital gains tax, many high-net-worth individuals borrow against their assets. If you own a large portfolio of stocks or real estate, you can use those holdings to secure a loan. That loan gives you liquidity, cash you can spend, without triggering a taxable event. And here's the key detail. Loans are not considered income, so you can access significant amounts of money, maintain ownership of appreciating assets, and avoid immediate taxation entirely. Meanwhile, those assets may continue to grow in value, further increasing your net worth. Of course, this isn't free money. Loans have to be repaid, and they come with interest. But when structured properly, the cost of borrowing can be significantly lower than the taxes that would have been paid if the assets were sold. And in some cases, that cost can be offset by the continued growth of the underlying investments. This creates a cycle. Assets grow, loans provide liquidity, and taxes are deferred. And over time, that cycle can produce a massive difference in after-tax wealth. Another layer that often goes unnoticed is how business ownership changes the entire tax equation. When you earn a salary, most of your tax situation is fixed. Your employer reports your income, taxes are withheld, and your flexibility is limited. But when you operate through a business structure, whether it's a company, a partnership, or even a small side venture, you gain access to a completely different set of rules. Expenses become deductions. Investments can be written off. Timing of income and payments can be adjusted. This doesn't mean everything can be deducted. There are clear rules, but it does mean that the structure of your income becomes more flexible. And that flexibility is where optimization happens. For example, business owners can often reinvest earnings back into the business, reducing taxable profit in the short term while building long-term value. They can also take advantage of depreciation, amortization, and other accounting mechanisms to spread costs over time. And again, none of this is hidden. It's written directly into the system. But it requires a different way of thinking, one that treats income not just as something to receive, but as something to design. There's also a behavioral element that plays a surprisingly large role. High earners tend to make decisions with tax implications in mind before they act, not after. They don't ask, "How do I reduce my taxes on this?" after the fact. They ask, "What's the most tax-efficient way to do this?" before the decision is made. That shift in timing changes outcomes. Because once a transaction is complete, your options are limited. But before it happens, you often have multiple paths to choose from, each with different tax consequences. This is especially relevant when it comes to large financial moves. Selling a property, exercising stock options, restructuring a business, or even relocating to a different jurisdiction. These decisions can have tax impacts that last for years, and planning them properly can result in significant savings. Another often overlooked aspect is the role of thresholds and brackets. Tax systems are not flat, they operate in tiers. That means small changes in income can sometimes have disproportionate effects on how much tax is owed. Strategic planning can help keep income within certain thresholds, unlocking lower rates or additional benefits. For instance, spreading income across multiple years instead of receiving it all at once can reduce the overall tax burden. Similarly, coordinating income between spouses or family members, where legally permitted, can optimize how income is distributed across different tax brackets. These strategies aren't about avoiding taxes entirely. They're about smoothing and optimizing how income flows through the system. And when done consistently, they can produce savings that compound year after year. It's also important to recognize that these approaches come with trade-offs. Deferring taxes means they may be paid later. Borrowing against assets introduces financial obligations. Running a business adds complexity and risk. None of these strategies are purely free wins. But the key difference is control. The ability to decide when, how, and under what conditions taxes are paid. And that control is what allows high earners to align their financial decisions with long-term outcomes, rather than reacting to short-term obligations. There's also a psychological barrier that prevents many people from exploring these strategies. The assumption that they're only for the ultra-wealthy. While it's true that scale amplifies the benefits, the underlying principles are not exclusive. They exist across different income levels, just in smaller magnitudes. Holding investments for longer periods. Using tax-advantaged accounts. Being mindful of when income is realized. Understanding deductions and expenses. These are foundational concepts that apply broadly. The difference is consistency and intent. Millionaires don't necessarily use completely different tools. They use the same tools more strategically, more consistently, and often with better guidance. And that brings us to one of the most understated advantages: access to expertise. Tax professionals, financial planners, and advisors don't just file paperwork, they help structure decisions. They identify opportunities, flag risks, and ensure that strategies are implemented correctly. For high earners, the cost of this guidance is often far outweighed by the savings it generates. But even without a full team of advisors, developing a basic understanding of how these systems work can change how you approach money entirely. Because once you realize that taxes are influenced by structure, timing, and behavior, not just income, you start to see opportunities where you didn't see them before. You start to ask different questions, and those questions lead to different decisions, which ultimately lead to different outcomes. So when you hear that some people are saving $50,000 a year through legal loopholes, it's easy to imagine something obscure or inaccessible. But in reality, it's often the result of multiple small optimizations working together, each one grounded in the same principle. Don't just earn money. Understand how it's taxed, because the gap between what you make and what you keep isn't fixed. It's shaped by the choices you make along the way.